All right, let's get the big picture from Jeff Palma, global equity strategist at UBS Securities. Jeff, what do you think about Louisa's take there? I mean, there are some positive things that she points out going on in the U.S. economy, but they don't seem that positive, especially when coupled with the horrible sovereign debt crisis that never seems to get solved over in Europe, the horrible unrest in the Middle East, and the awful crisis that just attacked Japan and Asia. I mean, is there a reason to be bullish?
Well, I think it depends on your time horizon here. And if we look over the course of the year, I think valuations, expansion in the economy, earnings, balance sheet support are all the right positives. Tactically, I have to say, I find myself a little more cautious given where oil prices are. We're seeing signs that companies are struggling to continue to expand margins, and analyst forecasts are expecting that continued expansion of margins. And so there's some rising earnings risks. Growth is slowing down a little bit, or at least moderating. We have the European crisis on our hands still. So my sense is that from a tactical perspective, things are going to stay a little more volatile and a little bumpy for a little while longer.
All right, so that from a tactical perspective. From a technical perspective, Marion Bartel's out today, and she's talking about the S&P could fall as much as almost 10% before resuming the two-year-old advance. Jeff, what kind of maybe pullback might you anticipate at this point?
Well, look, in the U.S., we've only come off a couple of percentage points in the last couple of weeks. We came from 1350 down to here, so still you're only talking about a few percent. My sense is if you fall below 1250 towards 1225, then you're starting to talk about valuations in the U.S. below a 13 PE. You start to talk about north of 10% upside possibilities for the course of the year. You don't have to fall a lot from here to get things much more attractive, but you could easily go down 3 or 5%, I would think.
Hey, Jeff, it's Julie. I want to ask you about margins here, which you mentioned a moment ago. I mean, given that sort of rosy scenario, when you look at earnings, I mean, I'm just confused at how you get there, especially when you have all of these rising costs, oil not being the least of them, of course.
Well, my view is that earnings on a global basis, or even for the U.S., are going to be roughly flat on where we finished last year. So that ability for firms to continue to cut costs, I think, is very, very limited. And actually, I would suggest now, as oil prices are rising, is going to be even harder to do. The challenge is that the bottom-up estimates are forecasting, call it 15% earnings growth this year, as opposed to a more likely scenario that's going to be closer to 10. So I think that expansion of profit margin story is going to be very tough to materialize.
Hey, Jeff, it's Adam. I got to jump in here. Did you say earnings are going to be flat? In other words, $84 for the S&P this year versus everyone else saying 94? Did I hear you right?
No. Our forecast is 96 this year. It's that the margins are going to be flat this year versus last year, or from the end of last year. So you'll get paid for your revenue growth, basically, very high single digits. You might eke out a little bit more than that as well. So no, we're more like a 10% growth rate for the year.
I want to throw one more thing into this. We talked with Barton Biggs earlier. He's a hedge fund manager. We know him well. We talk to him often. He's got a pretty upbeat outlook for stocks. Listen up, everyone.
There's still a couple of black swans flapping around out there, but you know, unless you come up with a dire scenario, I think we're going to extend the rally into back through the highs of a month ago, and hopefully further than that.
All right. So Jeff, he's saying maybe 10 to 15% higher from here. I mean, I think what he's basically saying is, yep, there's going to be things that happen. We've certainly seen a lot of events happen in just the last few months alone, but it looks like maybe the market can endure. Do you buy that the fundamentals out there, when you either look at the valuations, the earnings, the economic statistics, things are not so bad?
I think the key here is, does the economy continue to recover? And if that's the base case, and that's certainly our base case, the market can move to 1,400, 1,425. Our S&P target for the year is 1,425. We have the valuations on our side, but we just have to get through these sources of uncertainty in the near term. If we start to question those underlying growth fundamentals, I think that's where the story starts to unravel. But we're still pretty positive on that longer-term view.
So, Adam, we want to talk about at least one banking CEO maybe getting a big raise. I always like to talk about earnings. Sorry, personal earnings. I mean, compensation here. What are you looking at?
Well, there's plenty of that for Stu Gulliver. He's the CEO of HSBC, the largest bank in the UK. Here's what they're talking about doing. Going to the board to get approval for, you ready for this, a $2 million base, a cash bonus of $6 million, and deferred stock of $14 million. That would be total compensation of $22 million just for the year 2011. And it's an amazing contrast that someone could be paid, a banking executive, especially in the UK, where there was that onerous banking tax of anything over 50,000. Amazing that just 18 months later, we're talking about CEOs getting that kind of money. And Jeff, I've got to go out to you on this because part of what's curious about this is that they also want to tie it to reputation, brand, and compliance. How do you quantify all that?
Well, these are hard, but when we start talking about responsible investing and those sorts of things, I think governance issues become a very central part of that. And it's hard to quantify these things, but we know what the value of brands are, and it's an important part of the franchise of a firm, and anything that impairs that franchise value, in some sense, should impair those who are in charge of that brand. And so I guess I'm not surprised to see that we see companies trying to quantify that to hold up that element of their firm value.
I mean, everybody's trying to quantify the impact of Japan as they deal with what's going on over there. How do you guys quantify it, or do you feel like it's still too early yet?
I think it's pretty hard because the first order effects are the impacts on the Japanese economy very specifically, which, to be honest, from a global economic perspective, I think is actually pretty small numbers. It's the second order, those indirect effects that are harder to get a handle on. How much do supply chain disruptions interrupt earnings or profitability? How much do sales into Japan directly impact these things? I think it becomes very idiosyncratic. That is very company-specific issues rather than market-wide issues. But we're struggling to figure out all those impacts, because some of them, quite honestly, are only starting to come clear as we go through these couple of weeks.
Jeff, we got to run, though, but thanks for walking us through the close. We appreciate it.
My pleasure. Thanks.
Jeff Palma, Chief, or I should say Global Equity Strategist over at UBS Securities.